So now let's look a little bit further out past this year. And in this, the market or our tournament changes and the brackets or the regions change. So what we're looking at now is US-China economies decoupling, inequality, climate change, and fiscal and monetary policy working together. So let's look at the first one, US and Chinese economies decoupling. We don't think the trade deal will end this year, but we have some doubts about what's going to happen in the future. One of the things, if you look in sentiment in Washington, both Republicans and Democrats, their opinion towards China has deteriorated sharply. And if you look at this quote from Nancy Pelosi saying she agrees with Donald Trump on the threat posed by Huawei technology. I tell you unequivocally and without hesitation, be careful when you go down this path unless you want to end up with a society like China. Now, that's a pretty powerful statement and a negative one towards China. And the fact, what makes it even more powerful is that she agrees with Donald Trump because she doesn't agree with Donald Trump on anything. So negative sentiment towards China. From China's perspective, they're already starting to move away from the US. In an initiative called the Bricks and Road Initiative, China has invested $1 trillion in infrastructure in 60 countries around the world and trying to build their own supply routes. And what they're trying to do is rebuild the old Silk Road, and so they don't have to rely on the United States. In another initiative called Made in China 2025, China's targeting 10 strategically important industries to dominate. Now, how are they going to do that? Well, one of the things is you can see the Wall Street Journal saying Huawei benefited as much as $75 billion in state-backed assistance, financial assistance in 5G technology. It helped them charge 30% less for their equipment, and that's one of the ways they're able to dominate. This is exactly the state subsidies that the US is so concerned about, and it's going to be a subject of the Phase 2 negotiation. And China is not likely to cede any and give back any of this. So we think that it's going to be a real problem. US is already starting to fight against this. News out, the US is looking at preventing Huawei and other Chinese companies from getting access to important US semiconductor technology and also maybe even jet engines. So we see in the future this relationship continuing to cause problems for the markets. Another thing we're worried about is inequality. You can see that black line is the per capita GDP. It's sort of the growth rate of the economy. It's hard to see it, but underneath it is a red line. That is actually the income growth of the top 10%, the upper middle class. And you can see it's sort of tracking economic growth. The lines much above that is the income growth of the 1% and then the 0.01%. So you can see that that growth of inequality in the US that is very, very topical with populist politicians in the US. One of the reasons that's happened is you can see marginal tax rates in the US have come down. But what's interesting about this is the average effective tax rate of the top 1% has been fairly steady. Even when you had higher taxes, the rich didn't pay more tax. And if you look at this, the subject of this book, The Triumph of Injustice, how the rich dodge taxes and how to make them pay. And if that doesn't send a shiver down your spine, it should. And one of the things Elizabeth Warren and Bernie Sanders have talked about is a wealth tax. It's all about getting the rich to pay what they think is their fair share. And this is, John's going to talk about taxes tonight, but this is something that is going to continue to be more and more topical, and again, could be an overhang for markets in the longer term. Now, it's not just, there's a generational aspect to this, and you can see from this chart from the New York Times, income growth for millennials after inflation has barely changed since 1975. They had 0% increase in income, whereas the fat cat boomers, you can see that nice increase. A book on the left here, The Theft of a Decade, How the Baby Boomers Stole the Millennials' Economic Future. And I like this sort of thanks for the money, love mom and dad from the piggyback. This is a good segue into another subject, which is climate change, because not only are the boomers taking the millennials' economic future, but they're leaving them a climate disaster. This is a picture of Greta Thunberg. She is the 17-year-old Swedish climate activist. This is a quote from Greta. "You say you love your children above all else, and yet you are stealing their future in front of their very eyes." That's a powerful statement. And as a boomer, just barely, I bow my head in shame. Now, to be fair, not all of her colleagues are as involved as Greta. Key West after spring break, brought to you by the kids so worried about the planet. This is an important but complicated issue, and tonight we're going to quickly talk about 3 different ways of looking at it. The economic cost of climate change, the cost of mitigating climate change, and what is the capital markets doing about it from an investing perspective. So this is a study done by the Dallas Fed, and what they did is they looked at what would happen to economic growth if we abided by the Paris Climate Agreement. And that means that the temperatures only increase by 1 degree over the next 85 years. They believe economic growth would go down by just over 1% by the year 2100. Now, it's not even across the world. Canada and the US actually would suffer more, China not so much. But this is what is really scary, is if we do nothing, if there's no climate change policies, temperatures will go up 3.5 degrees, and per capita GDP would fall 7.2%. And again, look at what happens to Canada, down 13%, US not as bad. So there's a big economic cost on this. And of course, we know the implications with rising water levels and more storms and all of that. There's a cost to mitigating this as well, unfortunately. And if you can see the European Green New Deal, this is what it would take to get to 0 net emissions by the year 2050, about 7.1 trillion euros, a lot of money. For the US, their Green Deal, which is 100% renewable in 10 years, according to Clearview Energy Partners, would cost just under $3 trillion. That's about 1 year's tax revenue. So when you look at these numbers, you think, well, those are big numbers, but if there's a will and if there's a way to allocate the money, it's actually probably doable. The technology's not quite there, but certainly these are doable numbers. Here's the problem, though, because look at where the emissions are coming from. It's not necessarily the US and Europe and developed worlds. China is the largest emitter in the world, and the growth is coming from emerging markets and higher growth economies. According to UBS, $90 trillion would be needed globally to meet the Paris Climate Accord. Keep in mind that 1 in 7 people on this earth don't even have access to electricity. And so there's a balance that needs to take place, the balance for the need for cheap and reliable energy for economic growth, and balanced with the damage and contribution to climate change. Now, what does this mean for capital markets? Because unfortunately, governments aren't doing enough of this. We've not seen the coordination globally, and we need leadership from people like the United States, and that's not happening. Now, investors in the capital markets, fortunately, play a role, and they are starting to take action. This is a chart from Goldman Sachs pointing out that according to the Global Sustainable Investment Alliance, more than $30 trillion was invested in sustainable mandates in 2018. That's up 34% from 2 years before. According to Jefferies, they think the growth of ESG investment could define the next decade for Western fund management industry, just sort of like passive investing did for the decade before it. What's the goal of this? And what's the role of the investment industry? It's to facilitate the movement of renewable energy. If you can lower the cost of capital for renewable power and increase the cost of capital for big carbon emitters, we can help facilitate that transition. Nicola Wealth Management, we're signatories of the UN Principles for Responsible Investing, and we've also just started a new Sustainable Energy and Innovation Fund managed by my colleague Jeff Ryan. So we're committed to this as well, and we think this is a very important issue that's going to continue to impact capital markets and investments in the near term. Last one we'll talk about, the last region, is fiscal and monetary policy sort of acting together. And if you can look at this chart, you can see in a normal recession, the Federal Reserve cuts interest rates by 500 basis points. We're now at 175 basis points. You can't cut 500 basis points. Monetary policy in the next recession is going to quickly, interest rates overnight are going to go to 0, and then you're done. Then it's fiscal policy, but that actually doesn't have a lot of room either. In past recessions, you can see how much the deficit to GDP decline or increases. Right now, the US is running a deficit to GDP of just under 5%. Already at levels where you normally are in a recession. So they can maybe go to 10%, which was where you went in the Great Recession. Then you're done. You can't borrow any more money. Or can you? because there's a policy or a policy or a theory with a lot of populist politicians and economists that by combining fiscal and monetary policy, you can issue as much debt as you want. You can't go bankrupt if you issue debt in your own currency. So there's no limit to how much debt you can issue. Social needs should determine how much you borrow, not how much tax revenue you accumulate. Now, you would look at that and you go, whoa, whoa, whoa. If you start borrowing so much money and you issue all of these bonds, won't interest rates go up if there aren't enough people wanting those bonds? That's where the Federal Reserve comes in. That's where monetary policy comes in and is coordinated with fiscal policy, because the Federal Reserve would print money and buy the bonds needed to keep interest rates low. Well, you say, whoa, whoa. If your Fed's printing money, wouldn't this result in massive inflation? Not if the economy is running below capacity, or at least that's the theory. In fact, only when the economy is running beyond capacity do you get inflation. And then, once that happens, the government will increase taxes in order to maintain inflation. Who will they increase taxes on? Well, of course, you know the answer to that. And we're very worried that in the hands of a populist leadership, that modern monetary policy could lead to some pretty dire results. We don't know when you're going to start to feel the burn. We don't think Bernie Sanders will be elected president, but according to Bankrate analysts, the U.S. is moving gradually more and more to the left. And unsurprisingly, it's being led by millennials. Now, there's lots of different areas they can spend money on, but we have three questions. Can politicians effectively allocate capital? No. When we get inflation, will politicians react quickly enough? No, they're not going to stop spending. This is like catnip to a politician. If taxes have to increase, who will pay more? It's likely the wealthy. And so we would point out, you can expect inflation over time to go up, and you can expect to pay more taxes.